that Sunbelt Business Brokers is offering to our clients. These webcast presentations are here to inform our business owners that when the time is right for you to move on to your next venture or retirement, that you're going to be well positioned to minimize taxes and maximize what you walk away with, because that's really the important thing. I'm Joan Young, the president of Sunbelt, and today our guest speaker is Monty Walker of Walker Advisors, who's a tax specialist with over 24 years of experience, including work with startups and established entities. Good afternoon, Monty.
Good afternoon.
We're so glad you're with us today.
I appreciate the opportunity to be allowed to be here.
Yeah. So Monty is going over a number of topics throughout the webinar that we'll leave, and then we'll leave about 10 minutes at the end for Q&A. If you do have any questions, you can enter those in the chat box on that bottom left-hand corner of your screen, and we're going to cover as many of those as we can in the allotted time. But if we don't get to your question, please feel free to call Monty or myself directly, and our information will be on the last slide for your reference. So, Monty, I know that I learned a lot of amazing information from you at the California Association of Business Brokers Conference, and I'm so glad you're able to share that with our owners of business today.
I appreciate the opportunity to be able to talk about these things. These are important, and I think that many business owners need to know what's coming down the pike for them.
Great.
Well,
you are free to start.
Very good. The key topic today is how sellers will be impacted by current tax trends. One of the big issues that we had coming out of this past year is what will be happening with tax rates. We had business owners all over the country on standby waiting to see if the tax rates were going to go up, were they going to be extended, what exactly was going to occur. Well, the sunset provisions were supposed to kick in, and the Bush tax cuts were supposed to cause everything to go back to where they were on May 6th of 2003. So prior to May 6th of 2003, the tax rates were all higher. And as a matter of fact, capital gain rates were sitting at a much higher number. Well, I'll say much higher. They were sitting at 20%. So had the Bush tax cuts not stayed in place, we would have seen this year immediately an increase to 20%. Now, that doesn't seem like a lot to a lot of people, but I know for a fact that when you work long and hard to make the most you can out of your company, 1% is an unnecessary hit. So right now, business owners can still gain the benefit of selling their companies and getting a 15% tax rate. Now, that's true whether they're selling assets of their company or whether they're selling the stock of their company. Now, unfortunately, it's not always that simple. People with C corporations, they don't benefit from long-term preferential capital gain rates. So C corporation owners, they have normal, ordinary taxes when the assets of a C corporation are sold. But for S corporation owners, for LLCs, for sole proprietors, all those parties, they will get long-term capital gain, preferential capital gain treatment when they sell their assets. So that is a 15% rate. This 15% rate right now, which would have been 20 had the Bush tax cuts ended, that 15% rate is going to stay in place for the next 2 years. So we will continue to see a 15% applicable rate for at least 2 years. And then those rates, though, they are going to go up. It is inevitable. The rates have got to go up at some point in the near future, right at the end of the 2012 period. I just cannot see this extending any longer than where in 2012. I had an opportunity to be in Washington in April and was doing some presentations with House representatives and dealing with their Small Business Committee. And so I got some one-on-one time to understand what is really coming down the pike from their perspective. And I picked up that, get ready, we've got rates coming up. We're going to have a rate increase of some kind. Now, I know that currently we are hearing things in the news. I heard Boehner this morning, Speaker of the House, talking about the fact that a lot of changes need to occur, but the Republicans are saying no rate increases. Well, of course, the Democrats say rate increases, but the reality is we are spending a lot more money than is coming in. So we got to do something. If the amount of spending is not coming down, then something must happen to bring in more money, and the capital gain tax is certainly going to be one of those options. Look at what's been happening with capital gain taxes now over a period of 30 years or so. In 1978, we saw capital gain rates drop from 35% to 28%. And that's a key number, because from that 28% figure is what the rebound kept being back and forth all the way from 78 until 1997. So as you can see, in 1981, we went from 28% down to 20. Then it came back up from 20 to 28 in 1987. Went from 28 back down to 20 in 1997. And now in 2003, we saw it drop from 20 to 15, which is where it stayed. So from 2003 now all the way through 2012, we've seen a consistent long-term period. And 10 years is a fairly decent amount of time for the rates to stay static. And now the objective for Congress, and when you see those rates on the chart there moving around, the objective from the congressional side is to stimulate the economy. So what happens is we see a stimulation occur when the rates go down, and then we see a stagnation effect, so everything gets stabilized. Then they bring the rates back up so that more money can come into the Treasury. Then people get stabilized there, and then you bring the rates back down. This is a constant process, and it will always happen that way for as long as we don't have a simple tax system. We'll use the tax codes to bring us up and down through stimulation in the economy. So it can't go down and stay low and then always have long-term growth. The importance of this is it's got to go up and down to keep people motivated in investing and spending, especially in the small business arena. Now, had the Bush tax cuts stayed in place, had they not stayed in place, we would have seen the pre-2006 rate, 2003 rates come in. That was the 39.6. So we would have seen all of a sudden an increase that would have taken us from where we currently are now, which is 35, up to 39.6. But that's not what happened. We did have an extension of the ordinary tax rates also. So 35% is currently the long-term, the top-tier rate. Now, there's a misnomer that happens on this, and I'm a believer of this issue. There's a myth that says allowing the high-income tax cuts to expire would have hurt small business. And what we're saying here is if this 35% rate had been allowed to go back up to 39.6, it would have hurt small business. Now, there is a truth to the fact that small business in a certain way would have been impacted. But would it have actually hurt the small businesses holistically? In my practice, most small business owners are not in that top rate. And I have a national practice, so I see a large spectrum of small business owners. It takes approximately $2 million to $2.5 million of taxable income before the average tax rate is at 35. And we're not talking about the brackets. We're talking average of 35. So for somebody to really get up into that range and be at an average of 35, that's a lot. That's quite a bit of money. And had the top tier been allowed to go to 39.6, it would not have hit most of the small business owners. There would have been some that it would have hit, but most small business owners would not have been adversely impacted by the 39.6. So although the 39.6 rate, top tier rate seems to be very onerous for most small business owners just during the normal operation of their business, that's not going to be a major hit. It really will hit those that have greater wealth capacity. So that is where the big issue for the 39.6 would be. But I will point out momentarily that there is a chance that small business owners who normally wouldn't be hit and bothered by that, it could hurt them. And you'll see that here in a few slides. Let's take a look at what's been happening with ordinary tax rates now for an extended period. Look in 1944 through 1963, the top rates were at that 94% to 91%. That is a tremendous tax. That is a demotivator. I mean, I believe everybody could look and say, well, 39.6, if we went to that, certainly not as bad as what we would have seen back in the 40s through the 60s at 94 and 91%. That is a very high rate. Now, in 64 to 82, we were still at 77 to 70%. and in 82 to 86 at 50, and then finally in 86 we dropped down to 38, and to 31, and it came back up to a 39.6 in 1994. So we can see even through the Reagan years up until 86, the top rates were still in the 70% mark, and that's not a motivator either. A lot of successful businesses can certainly, especially when they sell their companies, drop enough income to get up into those upper rates. And that's where most small business owners will face their biggest issues, is moving up into those upper rates when they sell their companies. But in this particular case, as you can see in 64 through 82, and even up until 86 with the 50%, many small business owners would have sold and been in that high level. So where we are today is really not as significantly bad as what we would have seen in the past. But we are currently still, through 2012, sitting at a 35% effective rate. I mean, a top-tier rate. So if somebody has enough income, i.e., you get up into at least $2.5 million worth of income, is there a chance that somebody could get up into that upper rate? Yes, there is. Yes, there is. And mainly it would be from selling a company. Where I see some of the more prolific problems coming, though, is where we deal with things such as dividends. And if a business has accumulated undistributed income, retained earnings, mainly we're talking about C corporations here. If we have people that are in C corporations, is it possible that those C corporations could be sitting on top of tax problems they don't even know it? Had the dividends not stayed where they were, and they would have reverted back to the pre-May 6, 2003 levels. And that means that the dividends would have gone back and been considered ordinary. Right now, out of a C corporation, dividends are taxed at the capital gain rate. So the capital gain rate is 15%. So these are for people now. A dividend that is dividended out to a trust, or that goes out to maybe a retirement plan, or a dividend that goes out to another corporation, like another C corp, those are handled differently. So when we're talking about these, like a 15% rate, we're talking about people who own stock in a C corp and receive a dividend. The dividend rate is currently 15%. Now, had that rate reverted back to the pre-May 6 level, it would have been ordinary. And that's where we can expect this thing is going to go in 2012. So by the time 2012 is coming around, these dividends are going to be up at ordinary tax rates. Right now, a C corporation, which sells its assets, not the stock, but sells its assets, it pays ordinary income tax inside that C corp based on the C corp tax table. C corporations do not benefit from preferential capital gain treatment, so C corporations thus don't get an internal 15% rate. But after the taxes in the corporation are paid, the dividends which come out do get 15% preferential rate to the individuals that receive the dividend. Now, starting on January 1, 2013, that 15 could go up to as high as 39.6, because now we're at ordinary rates. And as I said, it takes $2.5 million before you're averaging up into that 35% rate for an individual. Now let's take this into consideration. Let's say that there's a large accumulation of money inside of a C corp, and large is relative. For some construction companies, because of bonding they have to do, several $1 million could very well be in there. For other companies, for smaller bonding requirements, or they just want to have enough money for liquidity, $800,000 could be a lot. But let's say that any of those funds are in there. Let's take $1 million. Let's say a company has $1 million inside the C corporation, and that money has never been issued as a dividend. Well, if that money were to be issued right now as a dividend, then there would be a 15% rate, so there would be $150,000 of a dividend tax paid on that $1 million. If, though, that's assuming it's $1 million dividend. If, though, that the dividend never occurred, and now the dividend actually occurs maybe in 2013, starting in 2013, that dividend, instead of being 15%, causing $150,000, the top rate that's out there at that time could be 39.6. Well, if the person had enough income to cause them to get up into that upper rate, all of a sudden what would have been a $150,000 dividend could be almost $400,000. So simply waiting between 2011 through 2012 and then getting into 2013 then issuing that dividend could cause as much as another $250,000 worth of tax to be paid. So one of the suggestions that would be a wise decision is if a C corporation, so this is any business owner that would hear this presentation, if they're operating from a C corporation and they have accumulated retained earnings that have not been distributed, a decision to possibly distribute that money and go ahead and pay the tax and then loan the difference back in, they should consider that. So by taking $1 million as an example here, $1 million would be issued as a dividend, pay $150,000 worth of tax, that's the $1 million times 15%, and then loan the remaining amount, the $850,000 back in as a loan. That way now instead of showing it as retained earnings, it's shown as a shareholder loan. And by showing this as a shareholder loan, that money is not going to be taxed any further in the future. This way, you don't find these funds getting down into 2013, doing a dividend at that point, and paying the higher tax amount. So the smart thing to do, get those dividends done before the end of 2012, pay the tax, loan the difference back in, and that one decision alone, as in this example with $1 million, that one decision alone could save as much as $250,000 worth of unnecessary tax. So planning is the key to success. Ordinary tax rates are coming, and these capital gain rates that we see are going to go away at the 15% mark, very likely. And we are going to see, if everything stays in the direction it's going now, dividends certainly are going to move away from being treated as a 15% rate, and they're going to move into ordinary tax rates. One of the items that is forthcoming that's not talked a lot about is that there is an additional earned income Medicare tax coming down the pike, and this is as a result of the health care legislation. So under the Patient Protection Act, there's an additional Medicare tax on earned income. This is an additional tax that is on earned income of $200,000 for individuals or $250,000 for families. Where this will happen is going to likely be on the Form 1040 or 1040A, etc., whenever the tax returns are filed. This is an aggregate of total income. So the parties included on the combined tax return, what will happen is all the income will be added up on that tax return, and then if it exceeds, in this case, a family of $250,000 of total taxable income or more, if there is an excess, that excess will have a 0.9% multiplier applied to it, and then that will be the additional tax that gets paid in. So there's an additional Medicare tax of 0.9% coming, and that starts in 2013. So this is not that far away. That will be on income that is earned during that period, from 2013 forward. Now, there's a lot of discussion underway right now about pending changes in this health care legislation. So there is a great chance that we're going to see something occur with the health care legislation where there's a repeal on part of it, or possibly just amending sections of it. It's been very clear for years that our Medicaid and Medicare system is in need of assistance, financial assistance. So if something changes in the Patient Protection Act to deal with this Medicare tax, there's going to probably be something else that will come in to take its place. I think that doing something to bring in additional Medicare tax was needed. That this is a start, but it's tied into the Patient Protection Act. So if that act is somehow repealed, then this right here would go away with it. That's not likely to occur. We're probably going to see modifications in it. Now, another Medicare tax that's inside the Patient Protection Act is Medicare tax on unearned income. That's a 3.8% tax. Once again, this is for individuals making adjusted gross income of $200,000 or more, and for joint filers with adjusted gross income of $250,000 or more. So this will all occur on the filing of an individual's 1040 or a family's 1040. This additional Medicare tax will be applicable to dividends. It's going to be with interest. There's going to be capital gains. There's going to be pass-through income from S corporations. So you can see this is going to impact almost everybody. Almost everybody will be impacted by by this particular item. So let's think about a C corporation that sells. If a C corporation sells its stock, it does create capital gain. So there's no doubt, based on what the direction that these regs are taking us, unless there's a modification, starting in 2013, there's an additional 3.8% on capital gains that comes off of C Corp selling their stock. There will be an additional 3.8% tied to many people who just simply sell the assets of their company. So let's say an S corporation or an LLC or a sole proprietor. Say any of those, they sell, and sole proprietors would be a little different. I'll show you momentarily. But say S corps and LLCs. If they sell assets, then there's a great chance that an additional 3.8% will be applied to the gains coming off those assets. Now, I want you to see one thing that's very clear here. We are sitting right now at a 15% capital gain rate. That will only last through the end of 2012. Starting on January 1 of 2013, the capital gain rate is going to go to 20%. I actually myself am running going forward calculations, and that would be any analysis that I'm doing for a business owner that is applicable to, that would go into the future past 2012. So if I'm doing something that's going to be analyzing what capital gain rates would be for somebody 5 years from now, starting in January 1 of 2013, I'm using a 25% rate. I think it's a comfortable rate. It's not exactly halfway in between the 20 and the 28, which you saw on the chart earlier, but 25 seems to be more applicable. We are being told that those gain rates are going to go up, and the chances are Congress is going to move them up above just going to 20. But let's just look at this. Even if it was just 20, if the only thing that happened is January 1 of 2013, we saw the 15% rate go away and it get replaced with the pre-May 6, 2003 capital gain rate, which is 20. That 20 plus this 3.8 is going to be the real rate, because 20% is what we apply to capital gains, and in many cases now capital gains are also going to have this 3.8. So we're talking 23.8, not 20. And if we were talking about maybe a 25 effective rate, we're not talking about a 25. We're talking about 28.8. So this 3.8 is going to apply to most parties. Let me show you here how it would not apply. There's for the Joint Committee on Taxation report, this was an analysis of this particular area on the unearned income Medicare tax. The Joint Committee on Taxation reported this. That this additional 3.8 will not apply to what are called non-passive trade or business activities. Essentially what that is in the tax code, when you're dealing with taxes, you have people who are active and people who are not active, or investors, the businesses that are generally active type businesses and those that are inactive. So let's just get it down to the operation of a company. Let's say you have an S corporation, and let's say you have two people which own that S corporation. One of the people operates every day. The other person was simply a provider of capital. That happens often. You have more than one owner in a business. One person had the money. The other person had the expertise. So one person operates and runs the business every day while the other person doesn't. So the person with the money typically is the one, if there's multiple owners, that one person with the money is typically the one that will not be doing the actual operations. Now, in that particular case, you've now got somebody who is active and somebody who's not. The one who is active running the business every day, that's considered a non-passive person. The person who is not active, that's considered a passive. So by the definition that you see here on your screen, this will not apply to non-passive trade or business activities. That means one person in a corp could potentially be subject to the 3.8 while the other one is not. So two people who get pass-through income in the operation of their companies, one would have pass-through income that would be that the operator would not be taxed at 3.8, while the non-passive person, the one who just simply put the money up, the passive person, the one who put the money up, that's the person who would pay the additional 3.8. And this is certainly true when you talk about selling. So you go to sell a business, and you have all these what would have historically just been capital gains coming out of an S corp. That capital gain would have just simply been taxed at the capital gain level. Well, now you are going to have the 3.8 on top, so the one who runs the company and is active in it, that one would not have to pay the 3.8, while the one who is inactive or considered to be passive would have to pay. Can you see the problems in planning that are coming down the pike? You have multiple owners in the same business, each getting treated differently. So for the trick on this is to make sure that individuals who are involved in the ownership of an S corp, a partnership, or an LLC, that those individuals get active. They somehow do something by definition in the regulations, so they're spending time with the company. You don't have to spend that much time. You can spend 500 hours in a year and just make enough, be a part enough in the operations that you're considered to be active. It doesn't take much to get there. It's 5 hours a month, 4 hours a month on an average. So the trick here, get active. Don't let yourself be caught by being passive. And if you do that, you can probably avoid the additional 3.8% is coming down the pike on Medicare tax. Now, under the Small Business Act, there was a gain tax called a built-in gain. A built-in gain occurs when a historical C corporation converts into an S corporation. And there are many S corporations that are in the states right now which have historically been C corps. And the way this regulation reads is that if on the date of conversion, on the day that a C corporation becomes an S corporation, on that day, the Internal Revenue Code says, we want you to identify on that day what your gains would have been, your taxable income, what would it have been had you sold as opposed to becoming an S corp. So take a look at your company, determine what the value of it is, and then calculate what your gain would have been had you sold. That's called a built-in gain. The regulations say that for 10 years, from the day that that corporation became an S corp, for 10 years, if any of those assets are distributed or sold, then the gain associated with those assets will trigger, and the gain tax will be due. Now, this is certainly the biggest problem on this is certainly when a business is sold, because all of the assets generally are sold. And now all of the assets subject to this built-in gain, they trigger. Now, right now, in 2011, not 2012, but in 2011, there's a moratorium on this tax. That tax is normally 35%. So you can see the tax rate at the bottom of your screen. In 2012, this tax will go from 0 to 35%. In one fell swoop, it'll go from 0 to 35%. Now, what does that mean? Let's just, for simple calculation purposes, let me take you through what that means. Let's assume that a business, the built-in gain would have been $1 million. Say that business had converted 5 years ago, coming into 2011. Let's say it's in the moratorium right now, and let's say there's $1 million gain that exists on that company. So right now, in 2011, if that business were to sell or transfer to somebody else, the tax due on that 2011, for federal purposes, the tax due on that 2011 would have only been $150,000. Now, if that tax would have only been $150,000 right now, well, what would have happened to it next year? So the tax is $150,000 because only capital gain treatment is occurring on this in 2011. If in 2012 that same business is sold, all of a sudden it's not just $150,000. First, there's 2 layers of tax, and the 2 layers are this. There's a flat 35% that is due at the corporate level. So now, instead of a 15% at the individual level, the corporation, i.e. the S Corp, because it's still in its built-in gain window, starting in 2012, the moratorium goes away. So if that $1 million, if it gets taxed, it's going to be taxed at 35% at the corporate level, And then the remaining amount, the remaining $650,000, it then gets taxed again in 2012 at the capital gain rate, which is 15 for a dividend. What is happening here is the Internal Revenue Code says that once you convert from a C to an S, for the next 10 years, you're going to be taxed on that gain just as though you're still a C Corp. So the built-in gain rate is 35%. So it says you're going to pay a corporate level tax at 35, and then you're going to pay a dividend tax on the difference. So starting in 2012, what would have been 150, starting in 2012, it goes from 150 up to about 450 at the federal level. Why? That's because you have a 35% at the federal level. This is on $1 million. 35% at the federal level, then another 15% on the remaining 650. So that together equates to about 450. That same $1 million, starting in 2013, that same $1 million would jump from about 450 to maybe as high as 600, because now we're talking about a ordinary tax rate as high as 40%, which is a 39.6. So starting in January 2013, if that business had been sold in this year, they'd only paid 150 federal. And in 2013, it's now gone up to close to 600. That is the 35 on the $1 million at the corporate level, then the 650 remaining gets taxed at almost 40%. That puts you out there at about 250. The 250 plus the 350, there's your 600. This doesn't even include the impact of the state. So in a C corporation, there will be a state tax at close to 10%, and then you're going to have an individual tax on the remaining at close to 10%. So you can see the tax implication here is huge. But at the federal level, what would have only been 150 had that business been transferred this year, it will go to almost 600. It makes all the sense in the world to consider trying to get these things, get an S corp sold this year that would be subjected to this problem. It takes a tremendous amount of business and value growth to make up for such a tax loss. So those S corporations that were at least 5 years into their S corp window, starting for this year, they need to consider selling this year, because if you get out of this year and you sell any time between 2013 to 2017, any time in that frame, then all the way up to 2018, these higher taxes are going to be applicable. So right now is the way to get away from paying that tax. You could pay zero capital gain tax, but you could go higher and have to pay a higher tax. Zero built-in gain tax. You will pay that starting in 2013. Let's see, Joan, do you want to answer any? You want to pose any questions now, or just wait till the end?
Well, if there is anybody that has a question right now regarding the built-in gain, let's see. We have a question from Jack. I sold my company in the past. I should have repaid myself the shareholder loan before the buyer saw my balance sheet. The buyer discounted the loan and called it invested equity and would not seller, me, take it out. It happened to me.
Yeah, I can see what he's talking about there. That seller, they looked at that and they considered that to be invested equity, and then they wouldn't let them take it back out. Those are issues that come up with a lot of companies. Now, in this particular case, when we start talking about the things that I talked about earlier with the dividends being distributed and loaning that money back in, that's going to be real cash. Now, what happens in most of the cases, that real cash that's in there, when they go to buy the asset, you're dealing with working capital. So that real cash is in there. Part of that's working capital. Part of it's the bonding requirement, and it does add value back to the sale of stock if the stock's going to be sold, and it does add underlying value on the reason why that money should be used as a part of the justification to buy, especially for bonding. So it is true. It is true that you'll have some potential issues with people, but it doesn't mean that you're going to eliminate your ability to get the benefit for that. This is more so now for those people who are going to potentially have to get that money out there and pay their tax anyway. But you are correct. Sometimes positioning that balance sheet when somebody's coming to buy, it may be better just to go ahead and clear that out there and get it paid, and then put the money back in later if needed. That's a good strategy. I've told a lot of sellers to do that. Pay themselves those notes, then hold the money. Don't spend it. Hold the money. Put it back in if it looks like it needs to be added back as a part of working capital. There was it looks like somebody, Joe was trying to ask a question. I can't see if you can see that.
Yeah, it says an S Corp that's only 5 years old considered for a built-in gain tax.
No, if I think that I understand the question on that, what that's saying is if an S Corp is started as an S Corp and it's only 5 years old, does it have a built-in gain tax? No, an S Corporation that started as an S Corp does not have a built-in gain problem. So
it's just a C Corp that converts to an S.
Yeah, it's only a C Corp. So if the C Corp historically had operated as a C Corp and then it converted, then that's when this built-in gain problem exists. It does not exist for somebody who started as an S Corp from day one.
Okay. All right. I would just continue. I know you have some other good information to cover.
I do. Okay. The current for everybody to know, currently Section 179 has an expense limit of $500,000. So that's applicable to this year. That is for people, and this is important not only for operations. It's good for everybody who's on the call today to know that you could spend up to get up to $500,000 of immediate deduction on 179 property. That's equipment of any kind, and that's for this year. Now, starting next year, though, that goes down to next year to 125,000, and then starting in 2013, it's going to go down to 25. Now, I'm bringing this up so that everybody knows if you are looking to deal with buyers and motivating somebody who would want to buy the company, 2011 is certainly a time when they could get the most bang for their buck. They could come in, buy the company, take these one-time write-offs and get a whole lot much larger write-off than they could get by waiting to 2012 or 2013. So when a company is being purchased, the issues that a buyer expects is the same issue really that a seller wants too and expects. Everybody is trying to maximize post-transaction cash. They want the most in their pocket, period. Sellers want to maximize the tax write-offs and get the capital gain benefits, etc. The buyers want to do the same thing. They want to actually get those expenses through depreciation. Well, in 2011, they can get $500,000 of the assets they buy as an immediate write-off, as opposed to the $125,000 that would come in 2012, or all the way down to $25,000 in 2013. Now, this is an area that's manipulated a lot by Congress. So we see depreciation, special depreciation, 179 deductions, etc. We see these as a highly manipulative area, and I don't say that in a negative way. This happens to just be where there's incentives added. When there's a desire to incentivize people to invest and buy equipment, then you see the 179 deductions going up. When there's not as much of a need to incentivize people to spend, you see the 179 deductions going down. And whenever you have a 179 deduction, just like normal depreciation, you will have recapture. So what that means is when a business sells its assets, any prior depreciation that was taken on that, it will come back in as ordinary income. So when a business is sold, or just assets in particular are sold, if they've ever been subject to tax, if they've ever been subject to depreciation, then the gain that is calculated on the sale of that asset, that gain will come back in and be taxed as ordinary tax gains to the extent of any prior depreciation that's taken. So let's take an example of that $500,000. Say you sold to a business owner, you sold to a new owner in 2011. They took a $500,000 deduction on equipment, and then they ultimately sell again. Maybe they sell the business 10 years later. Well, if those assets they took the deduction on don't exist and they have gotten rid of them, what can happen is that they don't incur any recapture. But if they sold those same assets as a part of the base of assets, then those assets, because they had a previous $500,000 deduction on them, up to $500,000 worth of gain on those assets would be subject to ordinary tax. And then what we're talking about here is assets being sold by S Corps, LLCs, and individuals and sole proprietors. this issue of recapture is not as prevalent of a problem in a C corp because there are no preferential tax rates in a C corp. It's just everything is taxed based on the tax brackets. And so what we're dealing with here on recapture is how much of a gain on the sale of a piece of equipment is going to be hit with ordinary income tax versus a capital gain like 15%. That's the big issue when you're selling equipment. And unfortunately, any prior depreciation on equipment causes a portion, if not all, of the gains on that equipment to be subject to ordinary tax. That's called depreciation recapture, and that does apply to 179. A qualified small business stock gain exclusion. This is an area that's been in the code for years. What this applies to is C corporations which sell stock. So an individual who has initial stock that was issued at the point the corporation was formed, that initial stock offering or the initial issuance would generally qualify under the qualified small business stock exclusion. Now, prior to this exclusion being increased, and what we had here with the 2010 Small Business Act is the exclusion was applicable to stock that was initially issued between September 27, 2010 and January 1, 2011. Now, that was extended, and under the Tax Relief Act of 2010, that 100% gain exclusion also applies to any stock issued between January 1 of 2011 and December 31 of 2011. So any stock being issued this year, we're not talking about a new issuance, we're talking about initial issuance. Corporation gets formed, initially issues the stock, then that stock, if it's done properly, can be held, if it's held for at least 5 years and then it's sold, there will be a 100% gain exclusion on the sale of that stock. So if a business sets up as a C corporation and then operates in the future, then they would be able to not pay any gains on the sale of that stock. That's a unique thing that's available in the regs. Now, anybody that is on listening to this call and will listen to the recording, if in the past you have operated set up as a C corp and you've always been a C corp, then there's a strong chance that your stock too may qualify under this exclusion. Now, historically, the exclusions have not been 100. They've been like 75%. So I'm not suggesting here that somebody who set up 10 years ago as a C corp, that they would get 100% gain exclusion if they sell. That's not what I'm saying. There are exclusions in the regulations that allow part of the gain on the sale of C corp stock if it initially qualified as a small business stock, that there are regs that allow part of the gains to not be taxed. It just so happens that those same regs were changed and modified just for the period through the end of this year. So any new C corporations that get formed this year, those C corporations, if they're held for at least 5 years, then the sale in the future that could create a gain, that gain may not be taxed. It could be completely exempt from tax. This is only applicable to C corps. So a C corp cannot convert to an S corp and then convert back. That cannot happen. And a C corp cannot have operated as an S corp from the beginning and then convert into B, and then eliminate the S status and start being taxed as a C corp. You can't do that. It's got to be a C corp from day one, initial stock issued as a C corp, and then it stays as a C corp. So it never could have been an S corp. Also, this does not apply to LLCs that are taxed as a C corp. This is only pure C corps. The actual qualified small business stock, the gain that's excludable is going to be 10 times the taxpayer's basis in the qualified small business stock, or $10 million, whichever the case may be. So let's say that somebody has put $100,000. Let's make it more realistic. Most business owners will come in and put $1,000 or maybe $10,000 when they first set up their C corps. They'll do that. So 10 times 1,000, that's nothing. That's $10,000. 10 times 10,000 is only 100,000. So you notice that it's 10 times the taxpayer's basis, or $10 million. So let's say a business in the future is sold for $2 million, and the stock had initially been issued for 1,000. Well, 10 times 1,000 is only 10,000, but we don't have just a limit of 10,000. It says 10 times the initial or 10 million. So if something is sold for $2 million, but the original stock was only issued with a $1,000 investment, that person is going to get $2 million that is not going to have any income tax on it from the federal level. That is one amazing tax benefit. Now the thing on that is this: most small businesses are going to be sold as an asset transaction. So if somebody is going to approach this as a planning strategy, the people that really need to approach this as a planning strategy, they need to think about what is the likelihood that I would sell my stock. So businesses that have hub status, of course minority status, that type of thing, businesses that have a lot of contracts in them, businesses that have priority relationships and authorizations that are going to require the stock to transfer, businesses that have like Medicaid and Medicare billing numbers. For instance, home health care is a lot of the things that we see coming up right now in the healthcare industry, where they've got Medicaid billing and special billing numbers that are hard to get. And in many states, once they're issued, they may not issue anymore for years. Those types of companies are just almost compelled to sell stock. So any of those types of businesses that are starting up this year that are likely going to sell in the future, they know they won't keep them in their family forever, then considering a C Corp could be an alternative, because the chances are great that the stock would have to be sold. Somebody who wants into it's going to have to buy the stock, and this could be a way that years from now, if they're going to hold it at least 5 years, if you set it up this year, it could be a way for you to not pay any gains in the future. But those are limited. You need to really plan it through if that's what you're planning on doing, is trying to sell stock. Now, business transactions escalate when taxes decrease and increase. Okay. Now, here's the problem. Right now, tax rates are low. As people who would sell their companies, it's important to keep those to think about keeping the tax rates low now. Pay the least amount of tax that you can. It's not suggesting that if the tax rates go up in the future, you're not going to have an opportunity to sell your business. That's not true. Businesses will sell in the future. Unfortunately, they go through cycles. When the rates go up, there's a lull period, and then eventually business owners will start to want to sell. When the rates go down, usually there's an immediate reaction to that, and then there'll be a tapering off effect. Right now, there's a motivation. 2011 and 2012 are a very unique time period. Substantial tax changes are coming. Right now, 2011, even in the next year, just on the built-in gain. Those S corporations subject to built-in gain could pay zero built-in gain, and all of a sudden next year they could pay 35% plus the dividend tax. So it could be huge what happens to S corp owners who are subject to that next year. But as taxes escalate, the business or taxes change, business transactions go up and down with it. They will escalate at all levels. It's just at what point in that level will they go up and down. And expect 2011, to experience an overall increase in activity, just for the reasons what I've been explaining today. Business owners need to take a good, long, hard look at doing what they can to try to get their businesses sold this year. And if they don't get them sold this year, certainly before 2012 is out. This is a very unique time period. The day is coming when the rates are going to go up. And so people need to really think hard, long and hard about what they're doing with their companies. Don't let this time go by the wayside. Planning there is no transactions and time do not go together. Time is no friend to a business transition. Zero friends to a business transition. Business transitions need to happen when the focus is there, and every day that goes by, opportunity is lost, especially on how to plan around a lot of your tax and problems, structuring problems that come with selling a company. Time is no friend to it. You need to look at 2011. Now is the time. Tomorrow is not it. Well, I appreciate the opportunity I was provided to speak with you today, and certainly we can now, and Joan, we can engage any other questions.
Okay, I appreciate it, Monty. It was very informative. Mary had said she's an S corp. Is there any advantage to me to sell this year? I guess that's other than what you discussed.
Well, I would say that there is an advantage. The S corp's coming in the future. We talked about that. There's an unearned income tax that's going to come, an unearned Medicare tax that's coming down the pike. That's certainly one thing to consider. The ability for ordinary taxes to go up. Any equipment that is sold that has depreciation recapture, that's going to create ordinary taxes. Any scenarios where there's consulting agreements or non-competition agreements, those are all subject to ordinary taxes. Those things are going up in the future. The capital gain rate, just in particular, is going up in the future. And certainly if you're an S-Corp that's subject to the built-in gain, you've got that problem. I would assume you've probably pointed that out if you were concerned about that. But as an S-Corp, yes, I think now is the time for business owners to be thinking about transitioning. So there's no doubt I can with confidence say that now is a time that you need to consider selling your business. The buyers are going to know. If anything, the buyers know that these things are changing in the future. They're going to be looking for business opportunities now because people are going to be motivated to try to sell. So buyers are going to be impacted by these pending tax issues almost at the same level of interest as the sellers. So if the buyers know taxes are motivating people to sell, they're going to be looking for opportunity, and there are people out there right now that are coming to the market who want to purchase. There are many downsized individuals coming out of corporations that have tremendous amounts of retirement money, and there are strategies available for people to use retirement accounts to help buy businesses. Those people are looking for business opportunities right now. So, right. Mary, that could be, one of those people could be the people that would buy your company, but without you being out there, you would have never been able to get them to look at you.
And of course, in our other exit strategy series, we've talked about other motivations. It has to be the right time for them, and I think a lot of sellers have experienced kind of a downturn in the last 2 years, and a lot of them are considering, gosh, do I want to sell when I'm down? Should I hold on to it for 3 or 4 more years, to get it back up? But they may get hit with the tax, so that it might be a wash.
It could be, but one of the things that I've seen very successfully done, and that is this issue of the earn-out. So any businesses that had historically operated very well can show an upward trend going. I think that then the question has to be, do I wait for the upward trend and be years away from now, or can I show that trend is absolutely there, that it's creating intrinsic value? And if it is, maybe an earn-out is a good way to integrate it so that the buyers are not locked into paying the additional amount if the growth doesn't happen, but would owe the additional amount if the growth does continue.
Yeah, we're seeing a lot of that these days. So I think that was, let's see, Jack asked, is there recapture on that $179 deduction on sale?
Yes. Yeah, okay. The 179 certainly does create recapture. So when the assets are eventually sold, any of the deduction that was taken does come back in at recapture. But that's the same as ordinary depreciation also. So once you do a 179 deduction, after 5 years, essentially, on the average, after 5 years, the 179 is treated exactly the same way as ordinary depreciation. So they both get handled the same way. The thing is, you take 179 deductions because you want to benefit from the cash flow it saves right now, and then later on you may pay ordinary tax, but you got the benefit of the cash flow right now.
Right. So, well, I appreciate all of your insight into the new tax laws that are going to affect people. So it's been very valuable information.
Well, I do appreciate the opportunity to have been a part of this today, and hopefully the people who listen to the live version plus any of the recordings, that they'll get some benefit out of it.
Absolutely. And we're going to, right there you'll see Monty's phone number and email. He is a tax expert if you need any help on that, as well as if you have buyers that are looking to buy a business. He handles transferring the 401ks into their new C Corp. I'm not sure what is the name for that, Monty?
That's a strategy that uses a 401k plan, and our proprietary strategy is called the Retirement Security Plan and Trust, and we've had that particular strategy active since 2002. And with that particular one, we serve as the trustee fiduciary and actually manage the process. So we can help buyers who are wanting to buy companies and use that retirement money. So it's a great strategy, and for people who are wanting to sell, they need to realize that money's out there and can be used to buy their company.
Good. Well, thank you so much, and thank you to everybody who was on today. And it will be on our webpage as taped webinars, so anybody who gets on our webinar, Monty, will learn about you and your information on tax.
Very good.
Okay. Thanks so much.
Great. Thank you.
Thank you, everybody. Bye-bye.
Thank you. Please stand by.